This video is going to discuss the 5 different types of investment risk: financial, market, liquidity, inflation, and fraud risks. There are risks and rewards to investing. Not all investments have the same potential return. Financial risk refers to the risk that a business or government that you have invested in would not be able to return your money. All sorts of businesses, as well as state agencies, have been known to declare bankruptcy. The United States government, however, in contrast, is unlikely to declare bankruptcy, so investing in U.S. government securities would pose little financial risk relative to other types of investments. If you put your money into accounts that are insured by the FDIC or the NCUA, you have little or no financial risk. So if you remember from a previous unit, the FDIC insures your bank accounts up to $250,000 per account. Market risk is the risk that the price of an investment would go down. The price of stocks, bonds, and mutual funds are determined by supply and demand. So that means that the investment values will fluctuate over time. The values are based on the quantities of an investment that investors are willing and able to purchase, basically supply and demand. Anything that changes the behavior of buyers and sellers can change the price of that investment. Now, during a worldwide pandemic, there's greater demand for goods that sanitize. Liquidity risk refers to the ability to convert your investments into cash. Checking and savings accounts are liquid investments. Stocks are also liquid. However, you may have to accept a lower price than what you paid for those stocks. Real estate and collectibles are not very liquid investments. Inflation risk refers to a general increase in the price of goods and services. Inflation can decrease the value of your investment. So over time, if prices are going up, the purchasing power of your money is going to fall. Investors are interested in the real rate of return rather than the nominal rate of return. To calculate the real rate of return, you take the nominal rate and you subtract inflation. The real rate of return is calculated by taking the nominal rate and subtracting inflation. In general, the longer your time horizon, the greater the chance that there will be inflation. Fraud risk refers to misrepresentation by dishonest individuals. It's important to do your research and make sure that you're associating with banks that are reputable, credit unions, and brokerage firms as well.